Yeah.
Hold on, the vote was November. That's not exactly a ringing endorsement.
Welcome to the trade room. I'm Blake.
And I'm August.
Here's the story everyone remembers. Company changes its logo, the internet loses it, Trump weighs in, stock craters, CEO takes the fall.
Clean little chain of cause and
Right.
effect.
Except the stock was up close to 100% when she actually walked out the door.
Wait, up.
Up. So that tidy version doesn't hold together.
Which means we're spending the whole episode taking it apart.
Piece by piece.
Starting with that November vote. Davila lost his board seat. Masino survived his proxy-advisor cover. Something shifted after that, though.
Then we run the real math. Her severance, David Deno's pay package, and Biglari's own billion-dollar claim about lost value.
Plus, what it means when a board defends a CEO legally instead of actually standing behind her.
And what Deno inherits, a stock near 46 times earnings and a brand new operational reset.
A lot of ground to cover.
So, that November vote, what actually happened in that room?
Let's find out.
Now, the Wall Street Journal reported the board started interviewing replacements in January, 2 months after shareholders voted to keep her.
Wait, January? That's barely after the vote closed.
Exactly. Watch what everyone actually remembers instead.
Right, the version everyone has in their head. Cracker Barrel changes its logo, drops the old timer by the barrel, the internet loses it, the president weighs in, and eventually the CEO pays for it.
Clean story. Satisfying story. Wrong on timing.
Julie Masino steps down as CEO and director effective August 10th, Cracker Barrel confirmed Monday. She stays on as an advisor through October 9th.
Sounds like a graceful exit. A logo backlash finally catching up to someone, a year later.
Except the stock closed near $53.71 on July 24th. Fortune's numbers had it up roughly 100% year to date.
So they're not removing her because the stock's collapsing.
No, they're removing her into strength.
And Cracker Barrel didn't give a reason for the exit. Forbes reported they stayed silent on it, which leaves the timing to speak for itself.
The search started in January, right after telling shareholders publicly she had their support in November.
So either that vote was theater or something flipped fast enough to reverse it in 8 weeks.
That's the part I want to know. What was the board actually saying publicly while this search was already running underneath it?
Building on that January thread, 2 months before the search even started, the board's out there defending her hard.
How hard?
The SEC filing had Cracker Barrel saying losing Masino would destabilize the company.
That's strong language for someone they're quietly replacing weeks later.
Gets more specific. On the November 20th meeting, shareholders re-elected 9 of 10 board nominees. Comp Chair Gilbert Davila wasn't one of them. About 60% voted him out, and he resigned that day.
And Masino?
Kept her seat. Roughly 75% support, down from 98 the year before, but she cleared it.
Wait, Davila chaired comp. He's the one who signs off on executive severance terms.
Was, past tense, which matters for where this is headed. So the board wins the headline, CEO survives, loses the guy who actually ran the comp committee.
Both ISS and Glass Lewis recommended exactly that split. ISS's own language, removing Masino would likely create disruption.
Disruption to what, though? The stock, the brand, or just optics for the board itself? That's the mechanics question. In a proxy fight, what a board legally commits to is defending the slate it nominated. That's an obligation to shareholders on that ballot. Defending the actual person is optional.
So they can drop her the day after certification and nothing about November was technically untrue.
Exactly, which is what happened. The search opened 2 months later.
So what changed in December? I've built plans around a CEO before. Hiring, CapEx sign-off, franchise renewal timing. None of that shifts on a 2-month whim.
Sales, maybe. Comp restaurant sales fell about 5% that fall quarter.
Then 7% by the quarter ending January 30th for the AP. And it didn't turn until the quarter ending May 1st, down 2.6. So the board defended her in public while the numbers kept getting worse in private. And started the exit paperwork before the worst of it even printed. That's not governance, that's a board buying itself time, which is exactly what's worth pricing next, what buying that time actually cost.
Building on that delay, let's put a number on it. The Wall Street Journal reported Masino's severance around $4.6 million.
Against what she was actually making, though?
Fiscal 2025 total comp was roughly $6.36 million. Base salary was $1.03 million.
So, severance alone is close to 3/4 of a full year's pay for someone the board just spent months defending.
And that's just her side. Deno's package is its own line item.
Go on.
$1 million base plus bonus and equity. The Journal also reported about $465,000 in relocation support.
Relocation? Is he even moving?
Not fully. A corporate apartment
Wow.
plus 2 trips a month home to St. Petersburg for 6 months.
So the company's funding his commute back to Florida while he runs a chain out of Tennessee?
That's the arrangement.
Now, Biglari Capital told shareholders roughly $1 billion in market value vanished under Masino. Walk me through that.
Stock was near $62 in late August 2025.
And the low?
$24.85.
That's a real move. But whose number is the billion? Is that independently calculated?
It's Biglari's own figure to shareholders, not an audited market cap loss.
So the activist running the campaign is also the one handing out the headline stat.
Correct.
What's the cost nobody puts on a balance sheet?
7 months of a CEO who knows a search is underway, still approving CapEx, still hiring regional directors.
And laying in. Franchisees notice that, don't they?
They do. Decisions slow down. People wait to see who's actually still there in 6 months.
So it's not just the severance check and the apartment in Nashville.
It's an organization running at half speed for the better part of 2 quarters.
Which sets up a question for the next conversation. What actually moves a board off a defense it just filed with the SEC?
Building on that lame duck math, here's the part that bugs me. Biglari's never actually won a board seat here.
0 for 8, something like that. Over 15 years. Restaurant business had that tally.
So walk me through it. If he loses every vote, how does he get the outcome he wanted?
Because the vote was never the goal. Fox Business covered this fight as costly and distracting, and that's Cracker Barrel's own language from the proxy filings, not his.
Costly and distracting. That's a board admitting the fight worked on them even while they were winning it.
Exactly. You don't spend that kind of language on someone who lost cleanly.
So the consensus is activists win by flipping seats. What if the real win is just exhausting a board into agreeing with you later?
That's the pattern I keep seeing with executives who survive one of these fights. Nobody fires them in the room.
What happens instead?
The decisions get smaller. Capital projects get tabled. A CEO who used to greenlight remodels is suddenly waiting on committee sign-off for things she used to just do.
So the board doesn't take the title, it takes the authority first.
Right. And by January, when the search starts, she's already running the company with her hands half tied for 2 months.
Which makes November's proxy-advisor cover look less like conviction and more like a stall tactic buying time to find Deno.
I'd stop short of calling it insincere. I'd call it conditional. We back you, for now, if the numbers hold.
That's not really backing someone. That's a probation period with a press release.
Sure, but it's the same probation every activist target eventually sits through, win or lose the vote.
So Biglari's 3% stake, 8 losses, and he still reshaped the org chart.
That's the uncomfortable read for boards everywhere. Losing the vote count isn't the same as losing.
All right, new CEO, same 46 times valuation the market's already pricing as the fix.
Let's see what Deno's actually inheriting. Shifting gears, Deno's about to sit in that chair. Best Buy, Yum Brands, Pizza Hut. Then he ran Blooming Brands from 2019 to 2024. He's on the boards at Krispy Kreme and Panera Brands right now.
So he's a turnaround guy, not a growth guy. That's interesting.
And the company just handed him a head start. July 20th, Cracker Barrel announced a sale-leaseback on 26 company-owned stores, dumped Maple Street Biscuit, and raised the fiscal year 2026 profitability outlook above that old $120 to $125 million adjusted EBITDA range.
Wait, they beat their own guidance before he even started?
Before day one. But here's my question. What has to be true for a 46 times earnings multiple to hold against a hospitality average closer to 24?
Walk me through the math on that.
The stock priced in a full recovery story. But every lever pulled so far, the sale-leaseback, the divestiture, the cut costs, that's balance sheet work. Nobody's shown me a same-store traffic number that justifies the multiple.
And Wall Street can't agree on which story wins. Bank of America's at $47, underperform. Wells Fargo is at $60, overweight.
That's a $13 spread on the same stock.
Same filings, same CEO, opposite conclusions. That's not a footnote, that's a live disagreement about whether this was ever a growth turnaround or just an expensive cleanup.
Deno didn't design the mess, he inherited the bill.
So the real test isn't the balance sheet anymore, it's traffic. Does Deno get the biscuits back or does he just manage the exit costs better than Masino did?
And if the multiple's pricing traffic that hasn't shown up yet?
Somebody overpaid for the story. Which brings us right back to the board that approved the whole thing in the first place.
And whether anyone stress tested a single word of it.
Building on that multiple, let's reprice the whole call. The board approved a $600 to $700 million transformation plan, greenlit a logo change, and never stress-tested customer reaction.
That's the part that gets me. You test a name change for a regional bank branch. Cracker Barrel skipped it on a brand people drive out of their way for.
So who owned that call?
Masino pitched it, the board signed the check. Nobody's name is attached to the customer risk sign-off specifically.
That's interesting. Silence on ownership usually means everyone assumed someone else tested it.
And they paid twice. Once to launch it, once to reverse it weeks later.
Was the November defense honest or buying time?
Honest in the moment, I'd guess. Wrong under pressure isn't the same as dishonest.
I'd push on that. They started interviewing replacements in January, 2 months after defending her publicly.
Fair. That's a timeline problem more than a character one.
Timelines are how you catch dishonesty without calling anyone a liar.
If I run it back, one change. Pilot the rebrand in 20 stores for 90 days before a national rollout. Cheap insurance against a 9-figure mistake.
Mine's on the board, not the brand. Put one accountable name in the filing for customer risk sign-off, not a committee.
Deno inherits that same structure.
He does. Whether he rewrites it is the next filing worth reading.
Time for our 2 questions. What went wrong and what would you change?
The board wrote destabilized to defend her, then started interviewing replacements 2 months later. That's the part I can't get past.
Mine's the shareholders. They voted to keep her. The board should have given that vote some weight before quietly job hunting behind her back.
Deno inherits a stock at 46 times earnings and a rebrand still unproven.
Next Tuesday's problem.
Always.
New episode drops every Tuesday. Subscribe wherever you listen.
And if this one changed your read on the whole logo story, send it to someone who's still wrong about it.
Thanks for hanging out with us.
See you next week.